So let's move on to the consumer sector. Again, following on the overall macroeconomic view that I have, staples I like. I like things that you need to have. You need Colgate, you need Kimberly-Clark, you need toothpaste, you need soap. So I want to talk about the auto parts sector. People are keeping cars longer than they ever have historically. The average life of a car now is 10 years. So there's a lot of interesting plays fundamentally. I want to take a look at Pep Boys. They reported Wednesday morning, had a strong quarter, performed well yesterday.
Let's take a look at Pep Boys. You know, the old adage in a recession or in a recessionary environment is that people don't buy new cars, they fix old cars. You know, whether or not that's true, I think it's worth looking at this sector. You know, overall, there's lots of different companies here that you know, make up this industry as a whole, Pep Boys being one of them. I do want to look at a longer term perspective. We are going to look at a weekly chart here. Little Manny, Mo, and Jack long term. You know, not a great trending stock. We can't really look at this chart and, you know, really have conviction about a trade. You can see, you know, lower highs over the last couple of years, which really doesn't speak about anything healthy going on here. That being said, you know, on the micro level, if we zoom in just a little and we look at maybe the last year and a half, 2 years, we do have a band of support down here at $8. You can see it recently held the $8 level. And if, you know, if I'm looking for diversity in my portfolio, a trade against $8 might not be such a bad idea here.
How about SMP? That's one that we don't talk about as much. It's a little bit more quiet of a name, but they're the ones who said that the average life of a car is now 10 years. They've been performing, you know, pretty well over the past year.
Well, you know, we had a nice move in 2009, 2010, and most of 2011 have been relatively quiet here. I would really want to see this stock approach these highs up here at $16 for a trade if I really was looking to commit capital here.
Okay, now one stock that we love to trade, AutoZone, that thing's a monster. Over the past 10 years, you've just been performing incredible.
This stock never ceases to amaze me. It really is an unbelievable trading vehicle. It's an unbelievable story. Again, if we look at a weekly chart going back, you know, almost an entire 10 years, you can see since early 2000, we've been, you know, clearly in an uptrend, and that uptrend over the last 2 years has really accelerated. You know, we've seen from basically the end of 2009, early 2010, the stock's doubled in price from 150 to now, you know, current levels at 315. That being said, from a trading perspective, it's a little rich here for me. I don't know if I'd be a buyer of AutoZone at these levels. I probably would wait for a pullback. You know, a good 10% pullback here would probably be an opportunity to buy it. Paying highs and paying up here probably isn't the best risk-reward scenario.
Okay, so let's move on to the discretionary side of the consumer space. Now, this is one that I don't like. So if I had to do a pair trade, for example, I'd go long, staples, short, discretionary. Gap, probably one of my most hated stocks. The product mix has been horrible since the mid-2000s with the whole skinny jean craze. So let's take a look at that one. GPS.
Yeah, sorry. Typing issues here. GPS. Not much to say other than sitting on the lows in a downtrend. We saw a severe sell-off from 24 stocks trading $16 percentage-wise. You know, that's really the last 6 months. Not the place where money is pouring into. It looks like an outflow of money. Right. That being said, if you're looking for a lower risk situation for a short-term trade against the lows here at 15, you know, may present an opportunity to get a trade back to, you know, the $18 level.
Same thing with American Eagle. There's top and bottom line pressure. Again, product mix isn't that great.
Retail, just not, you know, there are some stocks in retail that are very much in demand, and there are some stocks that are very much, you know, out of demand. This being one of them, very much like Gap, sitting on the lows. We have a little bit of support that's developed against $10. So again, depending on the style of trader you are and what you're looking for, a trade against 10, you know, has a low risk scenario, but this is a stock that's clearly in a downtrend, and the only thing that's going to correct this is probably time.
So technically on the charts as well, it's confirming our fundamental thesis that the staples are performing because it's stuff that you will always need. It's tangible. Whereas on the discretionary side, you can pass on certain things right now, and you know, maybe we'll get again more insight into the economy following Bernanke and President Obama's speech tonight. So we'll see, you know, fundamentally if it also lends to that. We're going to take a quick commercial break. When we come back, we jump into the trenches.